Hey guys, what's up? I'm Erin and welcome back to the channel. What if I told you that missing just one day a year in the market could cost you $100,000? Might sound unbelievable, but it's true. And today I want to cover exactly why. 2025 has been definitely a wild ride in the market. We're talking massive swings, dramatic headlines, and emotions running high. But if you've been feeling a little dizzy from all the volatility, you're not alone. Let's break down what's happening in the market, why timing it is completely impossible, and what history and the numbers show us is the real cost of panic selling and trying to outsmart these swings. Let's start with what's happening right now. Before April 9th, the market was in rough shape. The S&P was down about 15% year to date. The Nasdaq had dropped about 21%, and the Dow Jones was down a little over 11%. Investors were nervous, especially after President Trump's announcement of sweeping tariffs on April 2nd, which some have called Liberation Day. That announcement triggered a sharp 2-day sell-off. The Dow fell more than 2,200 points in one day with a 4,000-point drop in just 2 days' time. The S&P lost 6%. The Nasdaq dropped almost 6%, officially entering bear market territory. It was the biggest weekly decline since March of 2020. And then just 5 days later, we got one of the biggest market surges in history. The Dow jumped nearly 3,000 points. The S&P surged nearly 10%, and the Nasdaq soared 12%. And all of this was because a 90-day pause on most of the tariffs. And just like that, the tone of the market flipped. Well, until the next day when the market took some of those gains back. Volatility like this may feel extreme, but it's actually not unusual. Let's take a quick look at some of the biggest bear markets in history. Let's start with the Great Depression. The market dropped 89% over 34 months and took 25 years to fully recover. Then we have the oil crisis in the 70s. The market was down 48%. Recovery took about 6 years. We have the dot-com crash in the early 2000s. Market was down 49% and recovered in nearly 5 years. Then we have the Great Financial Crisis, where the market was down 57% and took about 4 years to recover. Then we have the COVID crash. The market was down about 34% and recovered in just 6 months. These events show us that bear markets are just part of the journey, but over time the market does recover. We just don't have a clear view of what that recovery will look like or how long it will take. And while the price-only recovery of the Great Depression took 25 years to happen, that doesn't truly tell the full story. Because if you had reinvested your dividends, and dividends at the time were at historic highs, averaging around 7% or more, so if you had reinvested your dividends, your recovery would have happened much sooner, in about 4.5 years' time, or the early 1940s. So this does show that dividends play a powerful role in softening the blow and accelerating your recovery. So when you reinvest those, especially in down markets, they can have a powerful role on your portfolio. And here's a really important message that I want to drive home when it comes to bear markets. The biggest gains and the biggest losses in the market often happen right next to each other. If we look at April 3rd and April 4th, those were among the worst days we've seen in 2025, at least thus far. And then we look at April 9th, well, that was one of the best days we've seen, at least thus far. They were just 5 days apart. And this pattern shows up again and again and again. In 1987, around the time roughly referred to as Black Monday, the worst day of the year was October 28th. The market was down 22.6% in a single day. And then one of the best days was just 2 days later on October 30th, where the market surged 10% in a single day. In 2008, it was up 11.6% and down 9%, all within the same week. During the COVID crash, we had a 12% loss, followed by a 9.4% gain just 8 days apart. During the Great Depression, the best and the worst days were literally 2 days apart. Hopefully this shows that timing is nearly impossible, and trying to do so will cost you big time. Let's throw in some numbers and see what it might cost to miss just one day in the market. If you invested $100,000 in the S&P 500 at the start of 2015 and just left it alone, today you'd have around $265,000. But if you missed just the single best day of every single year, 11 days total, your portfolio would be worth only about $167,000. That's a loss of over $98,000. Here's a simple way to think about it. Missing those 11 days would be like missing the 11 highest paid shift days at work. You still clock in 250 plus other days throughout the year, but by missing those 11 days, your paycheck is cut nearly in half. This shows how powerful just a few days are throughout the course of a year. Now let's imagine a magical scenario. What if you could skip the worst day of each year? Your portfolio would be worth about $427,000. While that may sound amazing, it's pretty unlikely because there's a catch. Those worst days often tend to happen back to back or in pretty darn close proximity to the best days. You often don't get one without exposing yourself to the other. At this point, you may be wondering, okay, so if I shouldn't try to time the market, what should I do? The answer is simply stick to your long-term plan. Stay invested and keep investing regularly. And if you're dollar cost averaging, just investing small amounts consistently over time, this can prevent you from having to think you have to time anything. You're just investing all the time. And one really great thing to think about is when the market is down, think of it that you're buying great companies at a discount. They're simply on sale. And if you're buying when the market is down, this is when long-term investors truly build wealth because their dollars go the furthest. They buy the most shares during that time. Perhaps you're also wondering, but should I do something during all this volatility? Totally valid question. If these kind of market drops are keeping you up at night, this might be a sign that you're invested too aggressively for your comfort level. So now you may want to address your long-term plan. You just don't want to react simply because of market swings. You want to have a long-term plan in place. How do I know if I'm taking too much risk? Here's a quick check-in. If market volatility makes you want to pull your money out of the market every single time that news turns red, that's probably a sign that you're taking on more risk than you're truly comfortable with. So what this means is you want to adjust your portfolio in a thoughtful and intentional manner, one that aligns more with your risk tolerance so you can sleep soundly at night. But it doesn't mean you want to go and sell everything. Let's shift gears and talk about why all of this feels so stressful. It's not just about losing money, it's about uncertainty. Psychologists talk about something called the intolerance of uncertainty, and this is a huge driver of anxiety. We're not just afraid of bad outcomes, we're afraid of not knowing what's coming next and feeling like we have no control over it. This can feel especially bad during times of market volatility for 3 reasons. We don't know when these downturns will happen, we don't know how bad they're going to be, and we have absolutely no control over them. When the market swings wildly and we can't predict what's happening next, our brains start spinning. It can feel like the ground beneath us is shifted and we have no control. We can start to act impulsively. Maybe we start to catastrophize. We start to panic. But here's the truth. The market has always been unpredictable in the short term. And the real thing that makes a difference is if you're going to respond with panic or are you going to respond with patience? Yes, the market is volatile right now, and I would say expect more volatility as we go forward, but that doesn't mean you abandon your plan. Time in the market always beats timing the market. If this video does anything, I hope it helps to give you perspective and maybe a little bit of peace of mind. Stay invested, stay grounded, and stick to your long-term plan. What are you thinking about what's happening in the market? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. I think I had defocus. I like to have a little bit of a softness in the background. Okay, I think I did before, but here we go. Completely impossible. Blah. Nervous, especially after President Trump. Why am I adding all these S's out of nowhere? It's just one of those days. I just want to go outside. It's Friday. Who works on a Friday? Apparently this chick this week, but usually no. I don't do Fridays. 3-day weekend all the time. Should be unethical to work on a Friday. It says it's recording, but I don't have my red box. That's kind of weird. Okay, so I'm gonna pause. Market sweet. Put your hand down, Erin. When I don't talk to myself in the third person, I don't even know why I said that. Just saw it and I'm like, put it down. I'm sorry. Someone is effing cutting their hedges right now. I mean, I wouldn't be annoyed about it, but they just did it yesterday. They didn't grow that much in a day. Can you hear the horn? Okay, so we couldn't hear the train. I can film through that. Can you hear the horn or the bell from the school? Let me know about that one.